All right, so just like the title on this YouTube video shows, this is exactly how I raised $1 million in 45 days, actually over $1 million. So in 45 days, I've raised over $1 million across two multifamily real estate deals. And this is not theory, this is exactly how it went down. Actual wired money from real people and on real deals. And my name is Hayato. I'm not selling you anything. I manage and own a real estate fund. I've closed over 250 plus transactions myself. And with my partners, we've collectively done over 1,000 plus deals in the last 10 years. And in this video, I'm going to go ahead and walk you through exactly how I did it, the pivots I had to make, the lessons I learned. And if you watch this through, my promise is that you'll know exactly how to do it yourself as well and learning from my lessons. So let's just go ahead and break it down. So these are the 6 core lessons that I learned that made it possible for me to raise $1 million in less than 45 days. And the number one thing that I learned, which was a very important learning lesson for me, was to find the deal first. So we tried to raise initially an open fund first, and it didn't work. We thought that we had enough of a track record where we could say to our investors and say, this is what we're looking for. We're going to go ahead and deploy your capital into X, Y, and Z, but we don't have an identified property yet. It's an open fund. We're going to allocate that fund into something that we believe it's going to make money. We thought that was going to work, but we were completely wrong. Every investor asked, what's the address? What are the numbers? What market is it in? And they didn't really care about our general fund or our sponsorship track record that much. Obviously, they took that into consideration, but they cared more about that specific opportunity and that deal. And this was a huge lesson that I learned from going through this entire process. And from there, we quickly pivoted and led with the deal and not the vehicle, which is the fund. We led with, this is the opportunity, this is the building itself, these are the numbers for the building, and this is exactly what you are getting into. And when you're starting out, people necessarily don't trust you yet. And these were investors that we've spoken with before, and they knew exactly what we did, and they knew our sponsorship track record too. So imagine having to try and raise capital for an open-ended fund that says, I will buy this real estate asset, or I will buy this business based on the P&L and these numbers that we're looking for. Imagine not having the deal and not having the sponsorship record and trying to raise capital. It's not impossible, but it's very difficult, at least from what my experience has been. So, all above all, people trust the deal first. So, my suggestion to you is, if you are just starting out, go and find that deal first. And eventually you can create an open fund if you have a ton of investors that have been in with you in multiple investments, and they can come into it with a blind eye because they know exactly what you do. Sure, maybe you can do that in the future. But if you're just starting out, find the deal first. That's what worked for us. The deal is what gives you credibility when you don't have a decade-long track record, and we did, and we still weren't able to go ahead and raise capital that easily. So that's a learning lesson, again, that I took heavily, and I want to give to you all as well. Number 2, present the deal so anyone can understand it. And this is a huge lesson because we spoke with, and I still speak with, a lot of different types of investors. Not all investors are the same. Investors, a lot of people think investors are the same because they have the same amount of capital. You need to meet the same requirements to become an investor. But it's not necessarily the case. You're going to talk to people from all walks of life. Some know real estate cold. Others have money. Maybe they're in the dental industry or healthcare industry, and others might be in crypto, or maybe they sold a software company and they made a ton of money that way. But maybe they don't know how multifamily works, or maybe they don't know how your business works, right? That you're raising money for. So you have to be fluent in both. And you might be speaking with investors who are extremely financially literate, and this is all they do. Maybe they're underwriters, maybe they are quants in a hedge fund, whatever it might be. They're going to be speaking in financial terms day in and day out. So that's what you need to know in and out. But others are not so. And so you need to be able to then switch gears and speak very clearly and explain in very simple terms why this is an opportunity and why it's something that they actually should be getting into. So for more novice investors, for more, and maybe not even novice, maybe experienced investors that are just trying to get into a different industry, you need to be able to speak your deal to anyone and any investor that you come across. Otherwise, if they don't understand it, they will not invest in it. It's extremely important that you understand this. So make sure that you know how to speak different languages in this raising capital space, because otherwise you will not raise capital. Uh, and if you can, use maps, photos, projections, side by side comps, whatever it might be. Use visuals to help you as well. And speak to what they care about. Is it return? Is it risk? Is it timeline? Is it for diversification? Understand exactly why they are looking to invest and why this is an opportunity for them, so that you're able to speak in their terms. They are investing for a particular reason. If you don't understand what that is, you're never going to be able to raise capital from these people. So make sure you understand what they care about, listen and really learn and hear out why they are there and why they're looking to invest their money. Cool. And the next thing is avoid acronyms unless you explain them on the spot. Acronyms are quite common in the real estate space. However, if you don't know real estate and you're speaking with an investor who doesn't really understand the multifamily side of things and they don't understand what those acronyms mean, and maybe they're in an industry where they have the same acronym, but it means different things. So at all times, I would avoid acronyms unless, again, you explain it to them on the spot. You don't want to create confusion. You don't want to go and end the presentation, and the investor didn't want to ask the question because they didn't want to feel embarrassed about asking a question about an acronym. So instead of creating that gap between you and the investor, just don't use acronyms and just explain what it is. Or if you do, again, explain what it is beforehand before you use it. So, bottom line for this one is if they don't understand it, they won't invest in it. Make sure that you can speak all languages that the investor speaks so you can present the deal the way they want to hear it and the way that they can understand it best. Cool. The next thing is very similar, but this is extremely important as well, is knowing your avatar. So, number one, know that not everyone is your investor. Initially, when we looked to raise capital, we actually reached out to everyone: institutional investors, family offices, accredited investors that make 200K plus a year. We reached out to all of them at once to see which one is our avatar and which one actually fits what we are looking for and what they want as well, because it goes both ways, right? We have an opportunity, and the avatar, the investor, they are looking for something. So it's a synergy. We want to find who exactly is looking for an opportunity that we can present them with. So given that not everyone is going to be your investor and not everyone's going to be your avatar, right? So for us, what we've found is our avatar is people making 200K plus that have a demanding W-2 job, but they love it and they want to get into multifamily, but they don't want to be operators. They want something that's fully passive, but they also want to get the upside of multifamily. So they want to experience ownership in a multifamily building and get all the upside as well without having to deal with tenants, without having to deal with the management side of things. And they can be 100% passive, so they can continue to focus on what's making them money at the moment and having this on the side so that they can either learn or they can either uh, diversify their investments into other streams to get into the multifamily space. So that for us is our avatar. And for us too, we even go a little bit deeper. So the avatars that typically come to us, they don't have the time or team to go after these 20 unit plus deals themselves. Some of them want to learn through watching. Others, again, want to diversify. So once we understood what this avatar looks like, we crafted every message, every deck, and every follow up that we created with them in mind first, because that's exactly the person we are speaking with. And it's helped us tremendously because we get better responses from them. And when we place ads and when we reach out to these people, we know exactly what they're looking for and what kind of deals that would make them interested and what kind of messaging would make them interested. And so you have to understand who your avatar is. Otherwise, no matter how many and how much you outreach, you're not going to see success in this short amount of time. So if you want success in a short amount of time, know your avatar. And in the beginning, you might have to cast a wide net, but continue to hone in from there and figure out who your best avatars are and go from there. So the last thing I will say is, again, know who you're speaking to and know what to say. Cool. The next part is know your deal inside and out. So you're going to have to anticipate every question and know the answer. Now, it doesn't mean you have to know every single thing in the world about like every little thing about your fund docs and the legal documents in your fund and whatnot. You should know as much as you possibly can. But in terms of your deal, because that's the deal you decided to pursue and go after, and this is something that you're presenting as an opportunity to your investors, you're going to need to know your deal inside and out. So know your comps if it's in the real estate space. Know your exit plan. What's your execution plan? What's the rehab scope? What's the debt terms? What's the rent rolls at the moment? Have you looked at the T12? What is the loss runs on the building? What does insurance break down to? What are the expenses? Everything that an investor could possibly ask you about the deal, you should know and be ready to break down the numbers too on the fly. You need to be good at mental math as well, especially if you're raising capital. That cannot be an excuse saying, I'm not that good at math. If not, have a calculator ready right next to you, or at least practice on a daily basis mental math, because some of these investors, again, that you're going to speak with are very financially literate and they're going to be throwing numbers at you, and you're going to need to be able to comprehend and calculate at the same time that these investors are looking at, so that you can speak with them in the same frequency and the same terms. So it's really, really important that you know your deal inside and out. And if you do, chances are the investor is running their numbers, but you've already ran that on your own. So you can go ahead and explain it. Maybe you don't have to crunch numbers on the fly. If you can, though, it always, always helps. So that's something huge that I would recommend continuing to practice if it's not your strong suit. Doesn't mean you need to 100% be able to do that to raise capital. It just will help you. And investors will test you. They will want to see if you've done your homework. They're going to ask all the questions that you may not have thought of too. And so what I would recommend is pressure test your deal with friends or family or strangers would be the last one to go with. Friends and family is the first one that you can go to get some feedback, but strangers are going to be the people that you're going to get the quickest feedback from. So if you are a little bit emotionally scared to go ahead and ask strangers for feedback immediately, go to your family and friends and ask them about the deal and see if they would want to invest. And if they say no, ask them why, right? You can feel more comfortable asking them versus strangers don't care about your feelings. They'll tell you straight up how they're feeling and why they're not going through with it. And that's what we did. We went straight to strangers because I don't personally care. However, if you do care, go with your family and friends first. If you don't care, the fastest way you're going to know why people are not wanting to go into your deal is by asking strangers, because they will bet with their real life hard-earned money, and they will only invest if they actually believe in you and the deal, right? So that's the quickest and fastest way to test it. And if you don't know your investments and if you don't know your deal, then they're not going to go ahead and trust you, because that means that you didn't do your homework, and they're not going to trust someone who didn't do their own homework on the acquisition of the deal. Cool. So last thing, confidence is going to come from mastery. It's not going to come from sales tactics. So the more you understand your industry, your deal, and why you're getting into the space, the more it will show and the more investors will feel comfortable investing with you as well. Cool. The next part is be transparent and trustworthy. So this seems like a simple and easy thing for most people to understand, but in practice, it's actually very, very difficult for a lot of people to do. And it, one, shows your character, and a lot of times character is what investors invest in alongside the deal. What even if the deal is a home run deal, if they don't trust you and they don't think that you're transparent, they're not going to invest with you. So here is the first point: nobody wires six figures to someone they don't trust. And trust, in my opinion, is built in two ways. One is track records, so things that you've actually done. And the second is in the way you communicate. And the first one, the active track record, is something you can continuously build up and it will only get better over time. Communication is something that is very fragile, and you want to make sure that when you do speak with investors, you're always upfront and transparent, because investors can smell BS from miles away. So for me and my philosophy and our philosophy with my two other partners is we are always upfront about the risks, the challenges, the worst case scenario that might come up, and we show investors how we would handle each of those risks and have solutions for it. And we tell them, hey, these investments might not always go according to plan. However, even if they don't, you can bet that we will be fully transparent and communicative on what's going on, because that is what's most important to us. Things can and will go wrong in investments. Whether you're Warren Buffett or Ray Dalio or Charlie Munger, there's investments that have gone wrong. It's just nature. It's just human nature. Things can and will go wrong. However, it's the way you handle those downfalls that allows an investor to trust you and how you operate for the future. So my philosophy is always be transparent and communicative of what's going on. And again, investors can smell that. So no hype, no fluff, just state facts. And transparency, I believe, helped us stand out, because a lot of people avoid talking about the downside. And honestly, we embrace it. It is just part of the game, and it's part of the investing game as well. And if you're not honest from day one, don't expect long-term capital coming back from investors, because at that point, they might invest with you for the first time, but then if you're not transparent, they're not going to invest with you for the second time. And that is going to hurt you a lot more than you just being upfront about it. And maybe the investor loses 1 or 2% on their investment versus them not coming on to you the second deal alongside with you. The last part that is really, really important about this entire capital raising journey too is being relentless with the follow-up. So people say no. However, no doesn't always mean no. It just means no that first time. And so when they say no, it doesn't necessarily mean no. They either forget eventually, and they might be open to that opportunity eventually in the future, or their no is just timing, or maybe they want to invest, but they don't have capital at the moment. Whatever it might be, you always want to make sure you follow up with your prospects and your investors, because again, people get busy, they get distracted, they just need a reminder. And so if they tell you, hey, don't follow up with me until this time, you obviously want to honor it and not follow up during those times. But after that period comes, you want to be able to reach out and say, hey, I know it's been a year. I know you didn't want to invest in it previously. Are you in a better position to invest now? And chances are, as you continue to follow up, people will come around and they'll see that you are great with your follow ups and that you are keeping them in mind. And that's going to help them get closer and closer to where you both want to be, where they might be interested in your opportunity and you might be able to raise capital from that investor. So your job at the end of the day is to make it easy for them to move forward, and for us Even with investors that we knew were going to come in, we still followed up every few days, not to pressure, but to serve them and ask them whether or not they needed any help navigating the portal, whether or not they needed help understanding any part of the deal, because we know that sometimes these investors, especially these accredited investors who make 200K plus, have very demanding jobs and they're already very busy. They might have a family that they take care of. So we know that we just need a little bit of a help to push them along. And maybe they're so busy they forget to ask. So do your part to help them move along, because if they say yes, they want to invest and you don't follow up with them, it's not their fault, it's yours. So make sure that you do so. We continue to answer questions, offer to get on calls, and just make sure that they didn't get stuck. And that's served very, very well for us. And some of the biggest investors that we had came through, the third or fourth, even seventh follow up. So just continue to do so and be polite, be consistent, and never assume a no is forever. Cool. So just to wrap it all up, again, you can do this too. And in summary, these are the things that I've learned that helped me raise over $1 million in less than 45 days. And just to recap, it's find a deal first, speak everyone's language, know your avatar, know your deal inside and out, be honest and build trust, and follow up relentlessly. If I can do it, so can you. Hope this video helps, and good luck.